Hey, if you're a business owner, you got to listen to this one. If you're worried about high taxes in your company, you're worried about taxes in retirement, you're worried about retirement in general, and you're worried about these new passive investment inclusion rules, this podcast is for you. We're going to dig into the corporate insured retirement plan, how you can grow your money tax free, spend it tax free. Let's get into it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren, I am doing great. I'm really excited to talk about this topic. It is a hot topic right now with some of the tax changes we've been hearing about, corporate business owners looking for new strategies. So I think this is going to be a really good one.
Yeah, I am super excited, and I can't wait to get into it.
Yeah, before we jump in, though, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're listening or watching on YouTube, please make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All righty, so let's dig into corporate-owned life insurance and the corporate-owned or corporate insured retirement program. So, we're going to touch on corporate-owned insurance today and talk about some of the benefits, but we're really going to try to laser in focus on just more the retirement portion. Now we're going to mention some of the other portions. And I say that this is not going to tell you everything you need to know about corporate life insurance, but it's going to give you a taste and hopefully create a desire to learn more. And, Christine, I've been in this business a long time, and I've seen insurance, the slowly increase in popularity. As taxes have gone up through the years, it became more and more popular. And now we're at a point. I was in one of the major accounting firms in Canada not too long ago, talking to the head tax strategy guy. It was an incredible meeting, and as soon as I walked in, he smiled and said, "Well, your business must be good," because he goes, "Every call I get now is about life insurance," and that's what again, the accountants in the big firms. You still have some small accountants that just don't want to learn about it and don't love it. But in my career, I've never seen the major accounting firms so excited about it. I mean, the Globe and Mail just had a great article about corporate-owned life insurance. This is finally mainstream. We always thought it was our hidden secret, our little gem that we had. But this is turning into a mainstream product now. So if you're a business owner out there, you owe it to yourself to learn about some of these concepts with corporate-owned life insurance, because the numbers are startling. So we're going to give an overview. We're going to talk about some of the benefits on retirement, and we call it a corporate insured retirement plan. There's all kinds of different names. There's corporate insured retirement program. What are some of the other ones? We've got corporate preferred retirement solution. All the different insurance companies kind of come up with their own little sort of takes on it, but they're all going to work pretty much the same way. Important to deal with the right company and the right advisor, because these are a little more complicated than your average life insurance policy. This isn't just buying a term insurance from your local guy that does everything else. You really need to deal with someone that specializes in this corporate work. So that's kind of the overview. Christina, comments?
Yeah, just to kind of mention that we're talking about a corporate lending strategy here. So a lot of the time on this podcast, you hear us talking about infinite banking and the infinite banking concept and strategy. That is a strategy in itself. Now we're kind of leaning into some corporate insurance strategy, something that I specialize in. I love working with clients on the corporate side. But the cool part is that we get to use the same product. So the same product's used for both. So we're not talking about infinite banking today. We're talking about an insurance or a lending strategy, a corporate insurance lending strategy, these retirement plans and whatnot. But the product that we use is for both of them. So just to kind of mention that it's a strategy that we're kind of walking through here.
Perfect. Yeah, thanks for that. And then if you talk about who is this for, well, really, it's for business owners that are incorporated, right? That's who it works for. So if you're a self-proprietor, maybe this isn't the right product for you. There's other products you can look at. Typically, we're talking to business owners between the ages of 25 and 60. There's some flexibility there depending upon health and stuff and how long you're going to plan to work. But really, this is for businesses that have retained earnings. So that means money that you don't spend every year. So in other words, if you make a couple $100,000, you pay yourself a salary, and there's money left over, and you have the ability to leave that money inside the corporation, that's really who this is designed for. And then ideally, we're going to want this in a holding company or a holding company eventually, because you've got to know going in that you're going to need this corporation for life, right? So if you've got a corporation that, you've got a couple partners and you're going to sell it in a couple years, maybe that's not the right corp to do that in, but we want a company that you're going to have for the rest of your life. And when you see the numbers, you're going to want this for the rest of your life.
I want to put one note on that too, because you said you should have retained earnings in the corporation. If you're pulling money out to save for retirement outside of your corporation, and that's why you don't have money left in the corporation, this could work for you too. So that's another piece I just wanted to throw in there, that if you're pulling money out for RRSP, you're saving personally for retirement outside your corp, this strategy could also work for you as well. So just a note there.
Yeah, great point. Yeah. And then we've all kinds of clients who, literally stopped taking an income, was able to take an income, a couple from RSPs or different places to grow those retained earnings to take advantage of these huge combination or huge tax benefits. And that's the whole point of our wealth coaching education call is we go through and we find the money for you where can we redirect it. So Christina, you mentioned similar infinite banking from a product standpoint. What product are we using for this?
Yeah, so we use that exact same product, high cash value life insurance, participating whole life. There's only 4 companies that we use to set these policies up. When we're, again, important to work with someone that knows the policies and the product. We need a participating whole life, but it also needs to be structured properly. So very key point, you can have participating whole lives that are not structured for high cash. Needs to be high cash value policy, participating whole life, paying a dividend every single year for the last 150 years. Those guarantees built in, always guaranteed to go up, never go backwards. We talk about it a lot on our podcast. So if you go back and you listen to a few, you've definitely heard us talk about high cash value life insurance and the benefits of it, but we're going to dig into the benefits of high cash value life insurance for corporate business owners a bit today and how we can use it for retirement.
Yeah, and we're not going to dig into whole life versus UL on this, but just trust me, if you got a UL and you're trying to do this, you've made a mistake.
It's not the same.
We reviewed one recently for a new client, and he was just shocked how inefficient the universal life was. So make sure you get the right product in there. Okay, so why is this so powerful? So let's look at a business owner. Let's say the business is making say $400,000, and they have that $400,000 left over at the end of the year inside the corporation. They've got a couple different options, right? They could pay that as a bonus or a salary. And, depending upon the province, you're going to pay 53% tax on that. So you're going to be left with 47% of that, right? So you pay $400,000, you could pay over $200,000 in tax. Or you could leave that money in the corporation and pay your small business tax, right? Which is 11-12% in most provinces. So if you leave that money in your corp, let's just use a dollar for a second. You have a dollar, you can pay it out to yourself in a salary. You're going to have about 50 cents or 47 to 50 cents. Or you leave it inside the corp and you have 88 cents. You pay your 12% small business tax on the first 500. And then you give yourself a dividend. Well, you're going to be left with roughly 50 cents. So that's going to mean no difference whether you take a salary or you give yourself a dividend. But where the real power comes from is, what if you don't need to spend all that money and you can leave it inside the corporation? Now for that dollar, instead of having 50 cents personally, you have 88 cents inside the corp. And that's the magic of this. We have 76% more money to invest day one. You've got a 76% bigger deposit than you do if you do it personally. So you purchase a participating whole life with the emphasis on that cash value, and then you fund the policy over a number of years. Again, these aren't single pays; these are funded over a number of ways. So those are kind of some of the points. What other points do you want to get into, Christina, on this?
Yeah, so a great point on that, but I do think that people would say, yeah, but Darren, we can invest in all kinds of things in our corporation with our 88-cent dollars. Why is this the product, or why would we want to use this for our retirement strategy, right? And this comes down to a few things, so a few additional things that I want to touch on. And that's, the first one is control. We say it all the time, but as a business owner, you need to be in control of your funds, because there's always going to be opportunities and expenses that pop up. And if you're putting away into a place that you can't access because it's for retirement, that's not ideal, right? If you're putting into, real estate that you can't pull out right away, that's not ideal. You need to have cash on hand, which is typically why we see a lot of business owners sitting on cash inside of their corporations, because they know this very well. They need to have access. So with this policy, we put the money in here for our retirement savings, for our, for down the road, but we still have access to it if we have an opportunity pop up, an emergency, right? So that's huge. We have control over our cash. It's also going to grow tax-free. That's huge. That's huge. Like, that's a big one. We're not going to have a passive income problem. That's much different than all of those other investments that you could use in there. We're also going to have the retirement plan. We're going to dig into a bit more. So it's not like you're just saving for the business and saving for investing. You're saving for retirement as well, which is great. We're also going to have way more income for the shareholders and a very big death benefit. So those other investments aren't going to have that estate plan built into it. And we're going to have that here as well when we use this product, which is great. So at the end of the day, it's going to be better for you. It's going to be better for your family. It's going to be better for your business, because it's not just doing one thing for you. It's one extra step that, that we're going to add to the process. That's just going to make what you're doing much better. You don't have to pick this right? You just add this, which is great.
Yeah, great points, Christina. And as we're both business owners and real estate investors, and we both pay a boatload of taxes. So when we talk to business owners and real estate investors, we feel their pain on that. But instead of just taking it, we've done something about it, and we both have policies or multiple policies like this. But let's dig into the taxes again just for a sec. Like, think of inside your corporation. Like, you could pay upwards of 50% tax on the growth. You could pay 40% tax to get that money out of your business. You could pay 25 to 35% tax at death on those assets. Then we're going to bring in this passive income, 50 grand, anything over that. And then we're going to bring in this new capital gains inclusion, higher rate. Like, that's 5 levels of taxation that aren't going to apply to this concept. So we're going to give you an example later of some numbers. And I just, we say this to clients all the time. We want to caution you before you see these numbers that, they're going to be so different, it's crazy. You're going to look at this and go, how can the insurance provide such a higher income, more death benefit, more benefits, more security than a traditional investment? And it's not because we're getting a 30 or 40% return on the insurance. It's if you can eliminate the tax on the growth, the tax when you spend, the tax when you die, the passive income, and the capital gains inclusion. If you can eliminate multiple levels of taxation, the numbers are mind-boggling. So, Christine, let's dig into an example, and then we'll go through an example, and I think it'll make a lot of sense to people when we go through that. So now, in this example, like we could have juiced it up and made it super aggressive and giving you the greatest numbers ever. We're just trying to give you a plain Jane example here. We haven't even used some of the top marginal tax brackets in this. We're just trying to, we're not trying to build a watch. We're trying to tell the time. So we're kind of trying to give you a big picture here. But we're going to look at a 44-year-old male who's going to deposit $50,000 a year into one of these corporate insurance policies for 20 years. So $1 million over a 20-year lifespan, right? So maybe they were doing a 30 grand a year in RSPs or something, and they realized that maybe that's not a great spot for business owners. They redirected that money, some other retained earnings, and then put it in there. Now, you can do 100,000, 200, 300, 500,000. There's no limit on what you can do, but we're going to use $50,000, and then we're going to do a comparison, right? So we can talk about the benefits, but compared to what? So we're going to compare it to a 5% bond. And I think we're being pretty conservative here. Business owners are typically conservative, and they need for the money inside their corp because they never know when they're going to need it. And, do you think you're going to be able to get a 5% bond every year for the rest of your life without a down year ever? No. But let's assume you can, and we'll show that comparison. So that's what we're going to compare. 5% bond inside a corporation at 50 grand a year for 20 years versus the corporate-owned life insurance. And what do you want to start with?
Yeah, so just keep in mind with that comparison too that you can't touch that money for the 5% to be there every single year. It has to stay there to get your 5% every single year. So it's got to stay in that.
It's really the 5% bond is an or asset.
Yeah.
You do this or that.
Yeah.
And 100%. Yeah. So when we talked about we're not getting into every aspect of this, just right off the bat, great point. I would much rather have corporate owned life insurance than the 5% bond, because in 2 years when my business goes south and I need to save it, I want to know I can access that money instantly, and not affect the growth of that money. Or if an opportunity comes along, I can take advantage of the opportunity, whereas the bond is just that or asset, and you're going to stop the compounding if you cancel it.
Exactly. So
All
it
right.
is, yeah, it's an important piece. But I want to start, okay, so with the retirement side, that's what we wanted to focus on today. So back to the retirement side of things. You're a business owner, you hit retirement. There's really only two things that you can do with your money, right? You can either give it away or you can spend it. And typically we're going to give it away on death if we're going to give it away. So I want to focus in on the death benefit side of things. We talked about it being tax-free on death, right? That the life insurance gets paid out tax-free to the corporation, and a comparison there. So we'll get to the income side of things because I realize that's very important. That's what we want to hear about. But the estate side is huge. Like I have clients that are business owners that have money in their holding corporations that they know that they're not going to spend, and they'd much rather their families get it than CRA. And this is the way that we do that. We structure these life insurance policies. So in this example, when we're looking at the comparison, like we talked about the GIC versus putting it into the corporate life insurance, well, the life insurance it's life insurance. So it is always going to win. So no surprises there. You know, year one, we put 50,000 into the life insurance policy, or we put 50,000 into the GIC. Well, the GIC, you're going to get 33 grand. The life insurance, your net estate value. So this is after it flows through the death benefit's going to pay to the corporation tax free. We're going to be able to flow the majority through the capital dividend account. And they're going to get 834,000 versus 33.
So 800 and some thousand versus 33. And again, like people go, well, I put in 50. How can I get 33? Well, you put in 50 of corporate money.
Yep.
For that money to go to your family, you still have to get it outside the corp. So that's what your family's going to get. That
Yeah, they're going to have to pull, the
33.
new shareholders are going to have to take a salary or a dividend, and by the time they get that out, they pay the tax on the bond, they pull the money out, salary or dividend, they're going to be left with that 33. On the other side, they're going to get 834,000 tax free. So I don't run internal rates of return on the death benefit because it just looks foolish. Obviously, it's very, very large. If we keep rolling out though, if we look at 20 years out with this example, this comparison, the net estate value on the life insurance policy is going to be 2.6 million, 974,000 on the other side after you've put that $1 million into it, right? So the estate side, it blows it out of the water. Like obviously it's going to do much better inside of this policy. And that's because we have that credit to the capital dividend account that happens when the death benefit pays to the corporation tax free. So beneficiary is your corporation, hits the CDA, and then the new shareholders are going to be able to pull that money out, or, you know, receiving shareholders, depending on how you're structured, are going to be able, that's a huge influx of cash to be able to get out as a corporate business owner completely tax-free. Like I don't think it's something that we should miss talking about, because it's a very efficient tax strategy for business owners to get money out of their corporation. And we can layer family members too, right? Like you see where you have your both spouses that are insured. If there's children, you know, adult children working in the business, you have them insured, you have the father or mother insured, so that you have the influx of cash there. And then on the next death, very, very tax efficient strategy.
Yeah, I mean, it's, you know, we say it goes to the new shareholders can withdraw that money. Typically in a business owners we're talking to, that a lot of times a family member.
Yes.
So a family member inherits the shares, and then that family member can take that couple $1 million or whatever it works out in your case too. So obviously huge win on death benefit, but really like the numbers are still massive, and people are surprised. And ironically, we actually designed this policy to maximize the cash, not the death benefit.
Yep.
So if someone had pure money that they didn't even care about how much income they could take or the cash value, we could actually maximize the death benefit, probably even a little more. But even when we're not trying to maximize the death benefit, insurance, because of the multiple layers of tax we're going to avoid, and the death benefit, it's a huge win. But, you know, it's not fun to talk about dying. Let's
about spending.
Let's talk about living and getting to spend more. Because, you know, I always joke, you know, you buy term insurance for your family because if something happens to you, they're provided for. You buy whole life for you. You buy a corporate-owned whole life for you. You and your spouse are going to be the people that this is designed to benefit the most. The bonus is that's going to help your family, right? And, you know, as people get older, that legacy becomes more important. But, you know, we talk to 30 and 40-year-olds going, I'm not really focused on the death benefit, but if this can allow me to spend gobs of money more tax-free, then great, sign me up. So if we look at the income, and again, we're just talking about one specific way, this corporate insured retirement plan to take
Lending
income.
strategy, yeah.
You know, in my first book, Be the Bank, I talked about 5 different ways you could take income in retirement. Well, there's more than that, right? We could have 5 or 10 ways. So typically, when a business owner has this type of strategy, when they approach retirement, they come in and meet with us or one of our wealth coaches, and we'll go down and say, okay, what's the most efficient way for you to take income? Let's look at your whole picture here and say, you know, maybe this strategy we're talking about is perfect, but maybe we can leverage other strategies because we have this. So there's all kinds of mechanics that go on. So we're just going to keep it simple today and say, if I'm going to use this policy as an income in retirement, how would it work? And there's really 2 ways to do that. It's called corporate borrowing or shareholder borrowing. So a corporate borrowing is pretty easy, right? It could be just simple as calling up the insurance company, borrowing money, and then the corporation borrows money and pays the shareholder a dividend. So maybe you think you're going to be in a lower tax bracket in retirement. Corporation's going to borrow money and pay out a dividend. If you do that strategy, another tax benefit is when you borrow that money, the corporation can write off the interest on that if it's used to be paid out to the shareholder. So in that dividend, the shareholder is going to pay some tax on the dividend, but depending upon their tax rate at the time, they may be comfortable doing it that way. The second approach is what's called the shareholder borrowing. And the shareholder borrowing really uses the policy as collateral for a personal bank loan. So now these are called bank loans, and there's banks set up basically just to loan on policies like this, so they're very familiar with it. And actually, I deal with one of the big 5 banks. When I first met them, and they went through my stuff and assets and stuff, they offered to loan me money on my corporate owned policies. Like, again, you got to be talking to the right people at the bank, but they do this. So shareholder borrowing, if you think of that, you use those corporate dollars, you paid your 12% tax, you grew that for 20, 30 years inside your corporation. You were able to access that 10, 20 times, take advantage of opportunities. Then you hit retirement. Now you take a personal loan. So a personal loan on that corporate policy. That's not going to show up in your tax return. It's not going to affect your government benefits. It's just going to be tax-free money. The whole time you're doing this, your compounding continues to compound inside the policy. So, you may retire and have $1 million of cash value. Well, it could hit 2 million in the next 10 or 15 years because it continues to grow. So that's why we typically see these incomes so much higher, is we can avoid all those multiple layers of tax and we never stop the compounding. So if we look at this sort of in the big picture, and just a note on that shareholder borrowing too, there's things called guarantee fees. There's accountants that need to be involved. There's things that need to be signed. So we're making it sound real simple, but this isn't your, Joe Blow insurance guy down the street's not gonna know the mechanics of this. You got to make sure you set it up correctly, because there's all kinds of things you have to do properly to make this work.
To keep it on side with CRA, you have to sit down with accountants. Big disclaimer that you have to be working with professionals in order for this to work properly.
Yeah. Okay, so back to the example. You put 50 grand in for 20 years, and we're going to use shareholder borrowing in this example. Income starting at age 70. Okay, so you don't have to retire at 70. You can retire at 50 or 60, but let's just say you start taking an income from this bucket at age 70. So if you do the 5% bond or GIC, you could take an income of $116,000 a year, okay? And you could do that for 12 years. So in 12 years, you have an income net to you of $116,000 with the 5% GIC. At the end of that 12 years, there's nothing left. Your family gets nothing. You get no more. End of story.
Like 1.3 million out of it for your million. Yeah.
Yeah.
Okay.
Exactly.
Yep,
all those years down the road,
tax.
right? Because of tax. Now, if we do the insurance with shareholder borrowing in this point, we can take that same $116,000 income, except this would be in the form of a loan, so we wouldn't pay income tax on it. And that, instead of lasting 12 years, it's going to last 21 years. So instead of taking an income for 9 years in retirement, you take an income for 21 years in retirement. So, and like, that's incredible. You're going to spend way more money. Oh, and when you die, not like the 5% bond or GIC where nothing is left, with the insurance, your family's going to get $1.4 million. So I just want to stop for a second. So you get to spend almost twice as much money, in some cases more than twice as much money, and you get leave your family million plus. What's the downside? Like this people look at this and the term we hear the most, Christina, is no brainer. Like, if I can show you a strategy to avoid multiple levels of taxation, give you control and access to your money for emergencies and opportunities, and then double your retirement income in retirement, or double the length of time you can take an income, and leave your family millions of dollars, but CRA doesn't get a big piece, do you think that would be a good strategy?
Absolutely. Anyways, numbers don't lie, right? When you look at the comparisons, the traditional planning versus the corporate insured plan, or what we're looking at here, it's substantial, the difference, and it has absolutely nothing to do with the returns inside these policies, because we've talked about high cash value policies earning between 4.5%, 5.5%, 6%, and we're comparing it to a 5%, but the numbers are much bigger, and that's to do with those taxes, right? You eliminate 3 layers of tax, that's huge.
Yeah. Okay, Christina. Anything else on that? So way more money for you, way more money when you die, and avoid multiple levels of taxation.
Yeah, and I also do want to go back to your point on having to work with a professional on this. So making sure that we're talking about lending strategies that we're using. An accountant needs to be involved. You need to work with a professional, someone that specializes in these products, in these banking lending products as well, to make sure that it's set up right. There's all kinds of acronyms out there that you'll hear, ACB, guarantee fees, CDA, lots of stuff that needs to be looked at. Just 100% make sure that you're working with the right person and that the strategy is the right fit for you. Like you also mentioned, there are lots of lending. There's different lending strategies we can use, different setups, different ways we can spend in retirement. Your setup is going to be specific to you. Make sure you're working with someone that can help you get the best strategy and the best setup for you down the road.
Okay, I want to give you an analogy for the corporate insured retirement program. Picture you could hire an individual, one more person in your corporation. Okay, you're going to pay that person $50,000. And that person is going to be like an AI bot, and they're going to work 24/7. They're never going to get sick. They're never going to not show up. They're never going to have family problems. They're going to work every single day. And what they're going to do is they're going to protect that $50,000 you give them. They're actually going to invest it in your name and protect it from taxes on the growth. No tax. They're going to protect it from taxes when you go to get that money out and need to spend it. They're going to protect you at death. If you were to die, they're going to arrive at your family's door with a big bag of money so your family can meet all their goals and dreams you had for them. Then, after 20 years, you're going to stop paying this person, but they're going to continue to work for you 24/7 every day till the end of your life. And then when you hit retirement, they're going to arrive with a big bag of money every single year, tax-free, for you to live a retirement. And then the day you die, they're going to show up and they're going to say, here's a big bag of money for your family right after your death when it's needed the most to pay the bills, keep the properties, keep the businesses in the family. Like, that's what we're talking about. So when we talk to business owners about $50,000 and $100,000 deposits, this is an incredible strategy that's going to provide, really, it's the ultimate employee. If an employee could do all that, why wouldn't you hire them? So that's kind of the corporate insured retirement plan in a nutshell. All right. Thanks for watching. Thanks for listening. Have an amazing day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.